Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate, with host Glenn Sutherland.
So this week's guest, we have Luke Thomas. Luke, maybe tell me a little bit about yourself and the company you work for.
Sure. Thanks, Glenn. My name's Luke Thomas. I'm a senior advisor at SolMar REI, based in Los Angeles, California. I have 39 years of experience in real estate, buying my first investment property in 1979, then selling our construction company in the mid-'80s, and then focusing in on brokerage, property management, mortgage banking, and working with investors with their self-directing individual retirement accounts since 1986. And I have about 8 years experience in corporate finance and venture capital. And then the company I work with, SolMar Real Estate Investments, is active in about 20 markets in the USA, primarily in the single-family and multifamily market space.
Cool. So you said 20 markets. I don't know if I want to put you on the put pressure on you to be able to rhyme those all off, but what are your main markets then, or maybe list off your favorite ones?
Cleveland, Columbus, Memphis, Birmingham, Huntsville, Jacksonville, Orlando, some other Florida markets. The big cities in Texas. We're pretty much, for the most part, in terms of activity, kind of like an L shape. So if you look at the map of the U.S. and take Cleveland and then go down to Houston and then an L over to, say, Jacksonville, that's kind of our market, really. Here in California, it's really an equity play, a buy, fix, and sell. The ROIs or the cap rates are just terrible, and the price points are very high. And then you've got landlord laws and other things that kind of muddy up the water.
So what does the company primarily do then? Is that's the main focus?
Yeah, the main focus is buy, fix, rent, and sell to cash flow or turnkey investors that are looking for income. And in the single family and multifamily market space within the median price point range of their respective markets. So that kind of just runs with all those markets.
So when we were talking on other conversations, you were sort of saying in the $500,000 mark. So is that you wouldn't be buying single family homes for $500,000, right?
No, we're typically, when I say $500,000, those are investors that are coming in and buying some single family duplexes, triplexes, quads. They just have that profile or makeup that they want to invest $500,000 or better.
Okay, so they're sort of buying a portfolio, a bunch of them at once?
Yes, and the ones that are not that experienced, they might be, stock investors or, something like that. And they're like, well, we'd kind of like to diversify. I'd like to get into real estate, have some rentals and so forth. Luke, what is the best way you think to go about it? And I've long advocated the pyramid fashion where, get a nice base of SFRs, then some duplexes, then some triplexes, then some quads, then 5 to 36 unit, and then 37 to 100, something like that.
For somebody like me who's a single-family home investor, but I've been liquidating some of my Canadian properties because of the high appreciation I've had in them, I'm starting to dabble with the idea of going straight to a multifamily. A lot of it just because I can afford it rather than buying a lot of single-family homes. What would be some of my advantages to switching to multifamily?
Well, less properties to contend with. So another aspect of benefit in a multifamily is you may have one local property management company or one local property manager that is just going to one property for, 4, 5, 6, 8 doors as opposed to driving all over town. He gets a little bit more intimate or familiar with that property because obviously the contiguous units are all like kind in construction.
Right. So yeah, I'm like a a lot of times you can have like the same doors, the same countertop, the same flooring. So if something breaks, you don't even have to necessarily go check out the unit first. You know that they're all the same.
Right. Yeah, exactly.
When I switched from evaluating single-family homes to go into multifamily homes, what are some of the differences? Like, instead of, am I still going to worry about the cash on cash, or what should I be looking at?
First of all, I think it's always good to view a property from its cash on cash return. And if you're then if you're going to finance, the cap rate or the actual return on your capital is even better. But you should buy something that has a nice return, cash on cash. And I think most of the benefits from multifamily, in my opinion, are just the having touched upon the things that we touched upon. Those are really the key components. And from a owner, if you have financing, you've got one loan for 5 doors or 6 doors or whatever, versus 6 mortgages and 6 doors. So all of those things, when you get into building a portfolio, all those things kind of add up, because somebody's got to do the accounting work, right? And no matter who's doing it, they have to be compensated somehow, even if you're doing it, and you're the entrepreneur and you're wearing all these hats. Well, it's a slice out of your time allotment to address those issues. So that's another benefit of multifamily. But I would still stick with the approach of building, in pyramid fashion. There's some single families, and here's kind of the flip side of that, or another consideration. I've had investors come to me that not really been involved in real estate, and they'd say something like, "Hey, Luke, you referred to me by so and so, and I just inherited $350,000 or something, and okay, and I want to invest in real estate. I want to buy an apartment building, down in the south or something." And I'm like, well, it's really better to build in this pyramid fashion. And I would go through the steps and the reasons why. And one inherent thing is that if you get too top heavy with multifamily, so you got 1 or 2 single families and then you have an 8 unit, I consider that top heavy, because you've got a lot of eggs in one basket there. So if for whatever reason you need to drum up some money, if you've got that pyramid fashion, you could just liquidate 1 or 2 SFRs or single family units, versus in the case of the example given, where this guy would have all of his eggs in one basket. If he ever needed money, well, he'd either have to get a loan or he would have to sell. And there's a lot more buyers for single family than there are for, let's say, an 8 unit building. And then if you need to sell fast, typically the discount percentage is higher on a multifamily as such, to sell quickly.
Do you find that, like, from multifamily compared to single family, that like a multifamily building will have to sit on the market longer in order to unload?
Yeah. I mean, all things considered, yes, because the amount of buyers for a bigger building as such, or 8-door building, there's not as many buyers for those as there are for single family. Because the investor psychology, there's a lot of investors that would say, well, I'm okay buying a single family to start off with. Most investors don't start off in an 8-unit building.
Right.
They start off with a single family and they buy another one, this kind of thing. So you have less buyers to sell to. And so therefore, to really get it to sell fast, you're probably selling to someone that's a little bit more seasoned investor, and you're going to need to discount a little bit more. So I'm just saying, from a safety standpoint, that pyramid structure, to me, over the 39 years that I've been doing this stuff, is just a lot of it just makes more sense. It's more stable. It's more secure. It's more methodical.
And so for the exact reverse, is there like a disadvantage to just only having single family homes, having a really big base with no pyramid?
There's nothing wrong with that. We've had a few years back, there was a real gold rush in the U.S. With hedge funds that just bought up literally tens of thousands of single-family homes. And they weren't really even messing with that much, from a percentage standpoint, that much in multifamily. They were just killing it on single-family. And single-family gives you a little bit more, and this kind of harkens back to the the buyer pool, is that depending upon the price point of the single-family, you can exit to an owner-occupant. It doesn't have to stay a rental property. There was a lot of big money coming in and just buying up lots of houses. So, and we're seeing that once again. There's another kind of wave going on, not so much the big hedge funds, but a lot of people with money. I talked to a hedge fund manager this morning on the East Coast, and they're looking to buy. Investors like the fundamentals of real estate, pure and simple.
Yeah.
And a lot of folks that I speak with, if they've been in the stock market for a long time or they're at retirement age or something like that, they don't want to play that stock market game anymore. They like the fundamentals. So they like the fundamentals of SFR. They like the fundamentals of a pyramid structure, and it can be long-term cash flow and depending upon the market, possibly even some good appreciation.
Maybe let's talk briefly just about the relationship between value add to the property, cap rate, and the actual value of the property.
Yeah, so it's kind of an interesting topic. The value add, obviously, in fact, I was that same investor I was talking to this morning. He was somebody had brought him a deal, and it was a self-storage deal. And he was sharing it with me, and the guy was talking about a 4.9 cap rate. And the guy that I was talking to, he says, that's crazy. But the broker, the real estate broker that was trying to sell him the deal, was saying, well, this self-storage, the rents are low. You can, increase the rents. There's a lot behind the buildings. You can add more units and everything. And so we both agree that that's not the intelligent way to look at it. You should, and here's the point, you should look at the investment as is. So if it makes sense, exactly. Value adds are just a icing on the cake or potential icing on the cake. And once you get past the existing cash flow and all the numbers work out for you, then look at the improvement basis and the return therewith. In terms of, cap rate, it's all over the place. I'm not sure if your question was with both or separate, but, the cap rates are really just dependent upon the location of the property and what it's throwing off or what it's producing in income on that cash-on-cash analysis we talked about. And then the other major component is, the borrower. If you're buying it, what is your financing source and what kind of rates and terms are they offering and how does that correlate with you, the borrower, on your down payment, your credit score, and your debt to income ratios. And then that really kind of determines the rate, which is really the basis of how well your down payment performs or produces a particular cap rate. Yeah, I think that for a lot of folks, they may get a little bit tied up in the cap rate, and I think if they stick to what is my cash on cash, then they go, hey, this makes sense. So, and if you've got the cash, if you don't, that's a different story. And I would make 2 points on that while we're talking about this approach to investments as it relates to single family or multifamily. But if the approach is, hey, you know what, I can live with this cash on cash return, but I'd like to leverage up. I'd like to bring in some financing and get a higher return on my capital, cap rate. Then it makes sense, cash on cash. Let me go see what I can do, get a pre-approval, and then once I get a soft commitment from a lender, I can plug in those numbers to see what my cap rate is. I think that's the most intelligent way to do it, whether you're SFR, single family or multifamily.
Yep.
And hopefully you have the time. And then my second point is kind of where we are now. When I say we, in America here, is things are going very, very fast. So a lot of the investors that we deal with, they're just coming in with all cash. And a lot of the sellers only want to deal with all cash unless they've got a kind of a junky property and they're just will take anybody, so to speak, and will wait for all of the financing logistics to happen in order to close. But my point is that sometimes, even if you get the pre-approval or the soft commitment from the lender, it may be a good idea to just go ahead and pay the cash, get the asset, and then refinance cash out later. And there's some sources out there that allow cash out in a few months period of time after you've seasoned the rent.
Is there any sort of benchmarks of what you should expect for a cash on cash for a multifamily? My biggest fear is to go buy some property that makes sense for me because it makes me a 20% cash on cash or something, but then I'm in a market where something changes in my life and I decide I want to sell this property and no one's going to buy it for the price that I bought it for. That
can be. I mean, that can happen. I've seen it happen before. But I'm not seeing it as much now. The current climate and the current momentum in the U.S. market right now is really, really good. I don't want to get too political or anything like that, but we've recently had some tax cuts and things that have really been favorable to real estate. So it's really kind of notched up the demand, and that kind of ties into if you see a good deal, it makes sense, cash on cash. You'd like to finance it, but if you may have a seller that doesn't want to wait around for the financing and all this kind of thing. Just execute. You got the cash to do it. You can always refinance later, and there's your cap rate, and then go buy another one. But to your point, we're seeing a lot of coverage. We're seeing the values all over the place are going up. So two things from that. Number one is not such a big worry. And then number two is, and I kind of taught this over the years to loan officers and real estate agents and investment counselors and so forth, is, if you don't understand economics, get the heck out of finance and investments. So in other words, if you don't have a feel for the economics around the property in which you're buying, example would be, you look at a property, it looks good, cash flow, cash on cash, and you say, oh, it looks pretty good. This property's in good condition, got a nice tenant credit package. The tenant's fully vetted, good tenant. All seems good. Well, wait a second. Are you looking at the economic fundamentals of the area around that asset or around that house or multifamily unit? What's the jobs market? What's the trend line? And that'll kind of help you address the point you just made.
You said at the start you were in 20 markets.
Mm-hmm.
What's your favorite? What if you had to, if you were going to start into this, do you have a favorite market that you like right now for multifamily?
I don't know whether you know this or not, but my wife and I traveled the Deep South and the Mid South for 3 years, buying, fixing, renting, and selling single family and multifamily units. And through that experience, I met a lot of great people and began to understand different cultures and so forth and so on, and what drives the economies and so forth and so on. There's certain markets that, and it depends what you want as an investor or what you're looking for. Which, just to your question, what I like, I mean, I've got a mixture of stuff. There's certain markets that are just really great cash flow markets. They're not really, and historically have not seen great appreciation rates, like a Memphis, Tennessee. Memphis is not a place where you put your money for appreciation. It is a great market for cash flow. Cleveland, Ohio is another one. A lot of the cities in the Florida markets, you can see both. You can see good cash flow, and you can see good appreciation. The problem with a lot of those Florida markets now, they're really tightening up. A lot of money going into Florida. So it's kind of like what we saw with Atlanta a few years back. It was really great deals, and boy, the demand just drove prices way high, and ROIs down, and this kind of thing. So it from purely what my favorite markets are, purely from a finance or an investment standpoint, some of the same old markets, the Memphis, the Cleveland, that type of thing.
Cool.
Yeah.
Before we go, maybe is there anything you'd like to talk about your company?
Well, I kind of gave an outline of what we do and a little bit about myself and my experience and so forth. But if any of your listeners have any questions or we could be of any help, they can reach us at our website, SolMar, that's SolMarREI.com, or they can call me at 1-866-947-2265. I'm at extension 808.
Well, Luke, I really appreciate you coming on the show. I know you've given me plenty of your time on the phone over the last year. But thank you. I really appreciate you coming on the show.
Oh, my pleasure. Thank you, Glenn.